As we enter 2022, many people are becoming increasingly worried that the stock market is going to crash within the next 6 to 12 months. Whilst 2022 is already looking to be far more volatile than last year, it's important to remember that crashes are very rare and unlikely. However, it is still important to know what these tailwind risks are, so that you don't freak out during corrections or days when the market plummets. I'll also talk about what kind of hedges may actually be useful if these things do actually happen this year. In today's video, I'm going to be looking at the risks that investors face for the year ahead with the stock market. Now, personally, I do think that the stock market is going to increase in value this year and most likely for many years to come, despite all of these online articles and professional fund managers claiming that the market is going to crash. So I'm also going to talk about in this video why I also see the stock market increasing for the foreseeable future. To start, let's have a look at the current valuation of the S&P 500, which is an index of the top 500 companies in the US. One way to determine the value of the S&P is by looking at the price to earnings ratio, which suggests that overall the stock market is overvalued. Price to earnings ratio is the ratio of a stock price divided by the firm's yearly earnings per share. It's essentially a measurement of how many years it would take an investor to earn back their principal from their initial investment. So for example, if you bought one share of Apple for $175 and Apple consistently makes profits of $5 per share per year, then it follows that it would take 35 years to earn back that original $175 investment. However, if you bought one share of Tesla for $1,000 and Tesla consistently profits $1.50 per share every year, then it would take you over 650 years to earn back your original investment. So why would anyone buy Tesla over Apple if it takes such a longer period of time for them to earn back their original investment? Answer is obviously the expected growth rate of Tesla's profits. Since investors have an expectation that Tesla's profits are going to continue rising for many years to come, they are therefore prepared to pay a higher premium or price for the stock today. If we therefore look at the PE ratio of the S&P 500, we can see that the stock market is heavily overvalued. Going back to the 1950s, the historical average price to earnings ratio of the S&P is around 19.6, which is shown to be a baseline of 0%. And as of December 31st last year, the S&P 500 PE ratio is 96% higher than its modern era average. And the only time it's ever been higher than this was during the late 90s, early 2000s dot-com bubble, which saw PE ratios rise to 127% above the average before crashing considerably. What has caused this big stock market rally in the 10 years since the global financial crisis? There's several reasons, but the main one has been the drop in interest rates. Fed funds rate was virtually 0% from 2008 through to 2015. And then as the economy started to pick up, the Fed gradually raised interest rates until about 2018. However, in 2019, they then reversed course, slowly lowering rates due to a weak economy. And then in March 2020, it reacted very swiftly to the pandemic by slashing interest rates to 0%. The stock market has risen by about 500% during this time. So understanding how interest rates impact the stock market can help investors understand how this is going to impact their investments in 2022. The Federal Reserve influences interest rates in order to control inflation. So by increasing interest rates, the Fed actually then decreases the supply of money, which in turn makes money more expensive to obtain. Conversely, when the Fed decreases interest rates, it increases the supply of money, thereby making it cheaper to borrow. Central banks in other countries follow similar patterns. These changes have ripple effects for companies that are looking to borrow money, as well as consumers in the economy. So when rates rise, it costs financial institutions more money to borrow, which in turn is then passed on to consumers. Individuals are impacted by increased rates to their credit cards and mortgages, meaning that they actually then have less disposable income to spend on other things. And when consumers have less discretionary spending money, business revenues and profits decrease. Businesses are therefore not only impacted by higher borrowing costs, but they are also adversely impacted by lower consumer demand, which in turn can bring down their earnings and stock prices. When the economy is slowing down, the Fed then cuts interest rates in order to stimulate economic activity. Lower interest rates are catalysts for growth, and they benefit both personal and corporate borrowing. This in turn leads to greater profits and a more robust economy. Consumers are able to spend more because the interest on their mortgage and their credit cards also decreases. Businesses can also finance operations, acquisitions, and expand at a cheaper rate, which increases their future earnings potential and in turn leads to higher stock prices. So lower interest rates benefit companies with stable cash flows and strong balance sheets, and they benefit from cheaper financing. If a company then starts to cut back on growth and becomes less profitable because of higher debt, and less revenue, their estimated future cash flow drops. With lowered expectations of growth and these future cash flows, investors don't get as much returns from the stock price appreciation. And in fact, the Dow actually dropped by 832 points in October 2018 due to fear of high interest rates. The Fed uses interest rates to control inflation. They want to keep economic growth steady and prices stable, so their goal is to use inflation targeting. And in the US, the Fed has an inflation target of about 2 to 3% per year. So when inflation starts to deviate from that target, then the Fed can then start to enact certain policies in order to bring inflation back to that target. The problem at the moment is that inflation has risen well beyond the 2 to 3% target in the last couple of months. Data from November last year actually shows that inflation has risen to 6.9%, and even core inflation has risen to almost 4.9%. Now, the difference between the two is that one just simply excludes food and beverages and energy prices, because those prices can be very volatile. So the blue line isn't really examined by the Fed when they are determining interest rates. Most economists argue that this rising inflation is from the pandemic, where people were at home during lockdown and they were able to save up a fair bit of money. But now, as a result of people coming out of lockdown, there is a huge pent-up demand for people to spend their money on goods and services. Now, this in turn resulted in higher spending during a time when supply chain issues were becoming really rampant. People also received government stimulus checks, and this environment of high demand and low supply has therefore caused prices to go up. The US Consumer Price Index has shown that in October of last year, prices of goods and services have increased. The highest annual price rises were for fuel, auto rentals, gas utilities, and used cars and trucks. The big question that investors have been asking themselves over the last 6 to 12 months is whether this increased inflation is only transitory, as the Fed has constantly described, or whether this is actually going to become a longer and more serious issue. If inflation is only transitory, then it's likely that the Fed is not going to raise interest rates, which in turn means that the stock market is likely to increase. However, if inflation isn't temporary, then the Fed will likely need to raise interest rates, which is going to have a negative impact on the stock market. There's also a very small risk that inflation could actually get out of control, and that will be a very bad scenario. Arguments supporting this idea that inflation is only going to be transitory primarily center around the idea that supply chain issues are eventually going to get resolved, and that this post-lockdown urge to go out and buy things will eventually subside. History shows that high inflation is often skewed by just a number of small goods and services categories, and it doesn't take long for normality to be restored and for prices to settle down. We can clearly see this in the current data, which shows that inflation is primarily being driven by rising prices in travel. So things like used car, gas, and fuel. Pent-up demand is also going to expire and waver because savings from lockdowns and government stimulus checks will eventually subside. Citibank, who are a major investment bank, have actually predicted that inflation is most likely going to die down by February 2022, as supply is eventually going to start catching up with demand and they begin to end the economic support policies. Unfortunately, there's also some very valid reasons that inflation isn't going to go down anytime soon, which is likely to result in the Fed increasing interest rates. People are convinced that price rises won't just be solely limited to industries that have been disrupted by the pandemic, because slower moving categories such as rent and apparel are also becoming more expensive. The second concern is the growing number of job vacancies and the potential for higher wages due to difficulty filling positions. In December last year, the US economy added 200,000 jobs and the unemployment rate fell to below 4%. That was the lowest since before the pandemic and compares to the Fed projection of 3.5% by the end of this year. And hourly earnings rose by 0.6% in December from the month before that, which was the largest advance since April, and pay also climbed by 4.7% from a year earlier. It's this sort of data which suggests that employers are willing to pay more for workers. Now, this in turn may mean that people therefore have more money to spend on goods and services, and therefore businesses need to accommodate for that demand by driving up the price of their products and also make up for the losses that they suffered during the pandemic. These issues, along with these supply chain bottleneck constraints dragging out for longer than what everyone had originally expected, means that inflation could be high for a much longer period of time. Big fear, or the problem here, is that the Fed might have to step in earlier earlier or sooner than anticipated in order to raise interest rates. So in this scenario, we would see inflation remain well above their target of 2 to 3% and potentially even increase beyond the spike in inflation that we see here. And if that's the case, then the Fed might have to act more aggressively, potentially raising interest rates higher and faster than what markets are currently anticipating. And markets don't like it when there's a discrepancy between anticipated rate rises and actual rate rises. So the Fed has indicated that they are going to raise interest rates in 2022 to 0.75%. So the cluster of dots in this graph represent each member of the Fed Reserve Board. And most of these dots or members expect the rates to increase 3 times to 0.5% by the end of 2022. And you can see that the expectation amongst the Fed board members and the market overall is that interest rates are going to continue to rise in 2023 and beyond. Key risk here though is that instead of these gradual rate rises, there's going to be a dramatic rise in interest rates if inflation starts to get out of control. In this kind of slamming on the brakes scenario, cash and gold are probably going to be the only good hedges. And this would most likely result in stock market declines. Now, one major voice in this space is Mohammed El-Iran, who's president of the Queen's College, Cambridge, and is an advisor to Allianz. And he is constantly arguing that the Fed is playing catch up in this space. So he argues that the US financial system has been conditioned by very low interest rates over the last 10 years. So this environment of ample liquidity and low borrowing costs would therefore make it very difficult for the Fed and the economy to tolerate higher rates. He argues that central banks are slowly starting to realize that inflation is becoming more widespread and rampant than they had originally anticipated. They will therefore have to play catch up, which also may then result in stagflation, which is a combination of high inflation and low growth. This would be the worst case scenario, as the value of savings would go down due to inflation, whilst at the same time job security would be low and the economy would go into a recession. So in this backdrop of inflation and potentially rising interest rates in 2022, where do I think the stock market is going to go? Well, a key factor here is going to be earnings growth in 2022. If we look back at earnings since 2014, you can see that things really started to pick up in 2018, where company earnings were growing by about 20 to 30% per year, before dropping dramatically during the pandemic. But after the pandemic, there was this huge rebound and surge in earnings, which in turn caused the S&P to grow by 20% last year. Now that we've had this huge rebound and upswing, brokers are forecasting that things are going to start to settle down a bit now. According to Refinitiv data, Wall Street analysts expect the S&P 500 earnings to grow by 7.9% in 2022. Compared to 43.9% in 2021. The poll also indicates that the Dow Jones Industrial Average will finish next year at 37,500 points, or will be up about 9%. Reuters also did a poll of 45 strategists and found that the S&P will gain around 7.5% by the end of this year. And of course, these are only predictions. No one actually knows where the stock market is going to be within the next 12 months. Really, it comes down to interest rates only predicted to rise by 0.75% this year, which compared to the historical average annual return of the S&P 500, which is about 8 to 10% per year. Even the 10-year US Treasury bond yield remains well below 2% and is currently sitting at 1.5%. And if there's one thing to take away from this video, it's to remember the long-term returns of various different asset classes. A recent 2021 Credit Suisse report found that the average yearly return of equities, bonds, and bills since 1900. And this is actually in addition to inflation. So remember that these returns are above inflation. Equities by far have outperformed all other asset classes, returning an average of 6.6% per year, compared to government bonds, which only returned about 2.1% per year. Finally, bills, which are short-term government duration bonds, have only returned 0.8% per year above inflation. So based on this historical data, it's highly likely that investing in the stock market for a very long period of time is going to result in the best returns out of these three asset classes. I'm obviously excluding crypto here because that's a new asset class and there's not enough historical data for comparison. So the key thing to remember here is that regardless of what happens with the stock market in 2022, you don't want to fall into the trap that I made of the paralysis of analysis. In 2017, I didn't invest because I thought the stock market was too high. In 2018, I didn't invest because I was worried interest rates were going to crash the market. And in 2020, when the market market crashed, I still didn't invest because I thought the market was only going to crash more when it had only doubled in value during that time. It's never a good idea to invest in the stock market for only a period of 12 months. One potential option could be to look at value stocks, financials, consumer discretionary, and potentially healthcare funds. Before I talk about value stocks, I'll firstly explain the Russell 3000 index, which represents about 98% of all US public stocks. It's split into the Russell 1000, which is the top 1000 publicly listed companies in the US, and the Russell 2000, which are basically the next 2000 or small cap companies. So what you can see here is the Russell 2000 index, which is in red, and that could also be split into growth stocks and value stocks. So this graph shows the price to earnings ratios of the index since 2003, and you can see that the growth stocks, which is in the blue line, has outperformed value stocks, which is in the green line. And that difference really started to emerge after the GFC ended around 2009, because that's when interest rates were slashed to record lows. And during the 2010s, this gap only got wider and wider because interest rates just got closer and closer to zero. In fact, in 2020 and 2021, valuations of these growth stocks got so high that they couldn't even fit it onto the chart, so they actually had to cut it off. And that's why it looks a bit weird here. But with the potential rising interest rates this year, you can see that most recently, growth stocks have fallen significantly in value, and they almost always revert back to their historical average price to earnings ratio. So I suspect that these growth stocks have further to fall because their current valuations of 45 is still a lot larger than their historical average. So for me personally, I'm just not willing to buy growth stocks at the moment because their premium is just too high to justify. Looking at the S&P 500 now for growth and value stocks, you can see a similar trend whereby the price of growth stocks is almost twice as high as value stocks. So since 2009, the price for growth stocks has increased and it's still well above historical averages, meaning that at some stage, or we don't know when, growth stocks will mean revert. And back in 2000, because there was a dot-com bubble, lots of people started piling into internet companies, and that saw the valuations of those companies exponentially increase before later crashing. More broadly, you can see how value stocks and tech stocks have performed over the last year in comparison to the 10-year Treasury yield. So here I'm comparing the XLK Technology Select Sector SPDR ETF, only has a small number of big tech companies, with the Vanguard Value Index Fund ETF, which consists of 335 value stocks. So in February 2021, when the 10-year Treasury rate started to rise, there was a huge sell-off in tech and the value of stocks outperformed the market. And that was until June last year when the 10-year inflected down again, and that's when we saw tech start to outperform value. The financial sector is also another sector that may perform well in a high interest rate environment because they're the only sector where net margins actually improve as a result of rising interest rates. Financials also make up about 30% of the ASX 200 as well. It also means that banks can potentially earn more in the spread between what they charge for customers and the interest that they have to pay to customers in their savings accounts. Interest rates also typically rise when the economy is doing better as a result of people spending more money. And that also usually means that borrowers have an easier time repaying their home loan repayments. And that may mean that banks are more likely to have fewer non-performing assets. Consumer discretionary stocks may also outperform during a high interest rate environment because of the improved employment market, meaning that consumers are more likely to splurge and purchase more food, groceries, and hygiene products. However, do bear in mind though that this sector did perform really well last year, with the consumer discretionary select sector SPDR fund returning almost 30% year on year. This return was driven by low interest rates, stimulus money, and that gave consumers heaps of disposable income. Stimulus is also likely to go away this year. GDP is expected to slow, and inflation is likely to remain high for several months to come. I'm not fully convinced that consumers are going to have heaps of disposable income this year, meaning I think it's unlikely that consumer discretionary stocks are going to be able to deliver the same return this year compared to the 30% return last year. Healthcare may also be another sector that performs well in a rising interest rate environment because despite what the stock market is doing, people just still need it. Therefore, its performance is less likely to be impacted by changes in disposable income, which is impacted by interest rates. So when interest rates rose in 2018, the healthcare sector sector ETF, shown in the blue line here, still delivered positive returns. Returns for the healthcare sector were also higher than utilities, shown in the orange line, and the consumer discretionary sector, that's shown in the red line. And they delivered about 4% and 1.6% returns, respectively, for that year. Sectors that may underperform in a high interest rate environment include non-profitable tech, gold, and real estate. The Goldman Non-Profitable Tech Index, which you can see here in pink, since the 4th of January, it has sold off sharply and it has fallen by around 10%. Whereas if you compare this to the S&P 500, you can see that the sell-off hasn't been as dramatic. It's only been around 2%. During this sell-off, this is also going to potentially impact other sectors. So Goldman also have a reopening index, which are stocks that benefit by the reopening and people resuming their normal activities. So things like airline stocks, restaurants, etc. You can see this is actually rising a bit at the moment, and the sell-off hasn't been as dramatic as non-profitable tech. The reason why non-profitable tech is falling is because of this potential for high interest rates, meaning that their future cash flows are getting discounted and their overall valuations are declining. So when people talk about the overall market crashing, the whole market isn't really crashing, in my opinion. It's just really being dragged down by this huge sell-off in non-profitable tech. Now, another potential sector which may underperform this year due to rising interest rates is real estate, because as interest rates rise, business loans start to become more unaffordable and the debt on those assets become more expensive. So it means that more of the payments is going to be charged as interest. Rising interest rates have also traditionally been bad news for gold. There's this inverse relationship between the value of the dollar and the value of gold. When interest rates rise, the value of the dollar increases and the value of gold goes down. Conversely, when interest rates decrease, the value of the dollar goes down and the value of gold increases. So if you assume that the US 10-year Treasury yield is going to go back up from its current negative rate of 0.6%, so back to the pre-pandemic levels of 0.2%, then it's possible that the price of gold, which is currently sitting around $1,800, is going to fall. That being said, gold could still go up in value if there's hyperinflation, although personally, I just don't think that there's going to be hyperinflation this year. More broadly, Vanguard recently released a report which shows the expected returns of certain assets and sectors over the next decade. So based on historical returns and current market valuations, their model predicts that US stocks are going to return between 2.3 and 4.3% a year over the next decade. And that's because current valuations are just so high. Now, interestingly, they think that value stocks have a higher probability of performing better. And they're predicting a 3.1% to 5.1% return per year during this time as well. Whereas with growth, that's centered around a 0% return. So because the US stock market is just so expensive, certainly in comparison to other markets, they're predicting that non-US markets are going to perform much better than the US, returning 5.3 to 7.3% per year. And then there isn't really much of a difference between emerging markets and developed markets predicted returns. Now, personally, I've just always been a bit hesitant to invest in emerging markets, really just because you're taking on a whole bunch of additional risk compared to if you invested in developed markets. The idea of investing in another developed market outside of the US may in fact be more attractive, because according to Vanguard, the predicted returns are potentially going to be the same as opposed to having to take on all of that additional risk of an emerging market. So using the PE ratio comparison from earlier in the video, you can see that the S&P 500 or the US market has a much higher valuation than the Euronext 100, the FTSE 100, the CAC 40, the DAX, which are stock market indices for England, France, Germany, and Europe. If you believe Vanguard's story here, then you can very easily buy an ETF that excludes the US market on the ASX. So one option for Australian investors is the Vanguard All World ex-US Shares Index ETF, or VEU. And that only has a management fee of 0.08%. So this ETF seeks to track the return of the FTSE All World ex-US Index. And this provides investors with exposure to stocks in both emerging and developed countries, including Taiwan Semiconductor Manufacturing, Nestle, Tencent Holdings, Samsung Electronics, Roche, and Shopify. Japan makes up the largest market allocation, followed by the UK, China, France, and Switzerland. This ETF has returned about 8.3% per year since its inception and has a significant stake in financials, consumer discretionary, industrials, and healthcare. It also pays a 2.5% dividend yield. So now let's put all of this together. Overall, I personally think that 2022 is still going to be a good year to invest, despite there being rising interest rates, because overall interest rates are still going to be very low compared to their historical averages. And low interest rates means that investors are more likely going to continue putting their money into shares, which in turn is going to drive up the value of the share market. It also means that in a low interest rate environment, you're only going to be getting at most maybe 1% return in a high interest savings account. That being said, this year is probably going to be a very turbulent year as investors become more weary about the potential of rising inflation and rising interest rates. If you're in the camp of rates spiraling out of control, gold and value stocks may be more likely to outperform the market. Personally, I think inflation will start to go down in 2022, and that will mean growth is likely going to outperform value this year, although we can't be 100% sure. And if you're somewhere in the middle, then maybe it makes sense to have a combination of both. I hope this video has helped you understand the current stock market climate. Why not share what you will think will happen this year as a comment below? Thank you so much for watching.